would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to a Friday edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please don't hold that against me. I hope you all have made it through the week intact. It's been a very home-focused week for me. As I mentioned, I've started doing some updates to the property to make it more marketable. And it kind of reminds me of advice I've given to you in the past when you're doing the same thing, trying to look at your property with fresh eyes. What are the things that would put off a potential buyer? And some of them are so easy to deal with. Well, some others are a little bit more difficult to deal with. But if you do the math, you do a little research and figure out what the difference between doing it is and what it would cost you to not do it. In other words, how much lower you'd have to sell the price for, how much lower of a price you'd have to settle for, should give you an absolute idea on whether or not it's worth doing. And that's kind of the exercise I'm going through, and I've actually sort of already done it, so I'm in the process of getting some of those things done. As always, head on over to the website, therebelbroker.com. If you'd like to get in contact with me, you can click on Contact the Rebel Broker and send along any ideas, suggestions, observations, questions, whatever you might have. Please feel free. If you prefer just to email me directly, you can send those to therebel@therebelbroker.com. Also, if you'd like to get yourself entered into a drawing for a $50 Amazon gift card, just head on over to therebelbroker.com, click on the big red button at the top that says Take the Survey to support the show. And come the first show that happens in November, we will be drawing for the lucky winner of that $50 Amazon gift card. Now, we've already drawn one. We drew one on the first show that happened in October. So that one's out. Congratulations to Shannon for winning that one. And I can't wait to draw the next one and see who wins that. So on top of potentially getting yourself $50 richer, you're also helping the show grow and doing me a big favor. So I appreciate that. And I appreciate those of you who've already jumped in and done it. Now, if you've, just as a reminder, I think it's been a few days since I brought this up, but if you are someone who registered very early on, way before I was offering the $50 gift cards as sort of an incentive to get folks over there, and you didn't provide an email address, please do it again and provide an email address. Because I can't enter you, I can't pick you if you don't have an email address. Once you go through the process, you're going to get asked your email address twice. Just make sure to use the same email address both times, and then you'll be entered in the drawing. So good luck to everyone who jumps in, and thanks for doing it. The other thing I'd like to do is thank the folks who've been visiting the website at therebelbroker.com. And I without much fanfare, I sort of just stuck at one place for ads on the website, just in the hopes of potentially generating some income to support the show there. And I've been kind of surprised. All I did was add it, and it's been getting some clicks, and I appreciate folks supporting the show by getting involved in the items that are being advertised on the website. The one thing I do want to mention is, while I have checkboxed things I absolutely do not want to get advertised on my website, I don't really have much control over what that is. So the banner ad that appears directly above articles or shows that are posted and below the player, well, the only ads on the site, I have no control over the specific thing. So take that for what it's worth. I've always tried to only put in front of you things that I think are good, or at the very least say to you, here's something that sounds like it's all right. I've never done it. Good luck. See if it's something that interests you. Consider those ads in that vein. I have not necessarily been exposed to anything that's being pitched to you in those ads. So I'm not endorsing. I'm just giving this ad placement thing a place to put some ads. And of course, I don't have much control over that. But you shouldn't see anything really creepy in there. The times I've gone and checked out what's rotating through on the ads all seem pretty applicable. They all seem real estate related or business related or personal success related. So far, so good in terms of just things you might want to consider making part of your efforts. But let me know if you're running into any problems. I'm really not interested in creating a gross or a lame or a place for exploitative stuff to get advertised. So just let me know if any of that is going on, and I'll try to fix it. We've got a couple of interesting news stories to tie together today. They're just sort of tidbits of information, then followed up with a big one, which basically asks the question, is it recession time? And what's interesting is this perspective, and again, we might want to call this another Tinfoil Friday because we are leading off with a zero hedge article. So maybe we'll make that sort of the theme for today a little bit because really the rest of it's not out there. This isn't even out there either, frankly. And this warning comes from a property manager, so it absolutely fits into our wheelhouse in terms of stuff that's focused on real estate that I think we really want to be aware of. I think we'll probably cover that in a few minutes, but there's a few other little tidbits of information I wanted to just share with you because I think these are numbers that it's worth knowing. According to the folks over at Calculated Risk, we've seen framing lumber prices are up year over year. Now, just to sort of make it clear, the reason why we care is because houses are made out of wood. So in terms of that resource being more or less consumed or orders for it increasing or decreasing, it gives us sort of a near-term expectation in terms of what might be coming down the pike, in terms of whether we're going to get more new construction or those kinds of things. But there are a few things that you need to keep in mind when we're looking at these numbers. In order to really get a handle on this, you kind of have to understand how wood gets used. Now, let's use 2015 as an example. Now, we covered this quite a bit in 2015 when these things were fluctuating because prices were down year over year. But we had a pickup in housing starts. So despite the fact that there were more people out there building homes, we saw a downturn in the prices. So if you're just paying attention to this number, it can be misleading. So what explains that problem in 2015? Well, first, multifamily construction uses less lumber than single-family construction. So that was one reason. But the other bigger reason, at least I think it's the bigger reason, some other folks disagree with me, but the decline in 2015, I think, was in a huge part in the low demand from China. China had been buying up an awful lot of wood from 2014 on, and we saw that collapse in 2015. And I think that was one of the big things that really affected how that number came together last year. Now, this year, for those of you who keep track of stuff that's going on with real estate in China, their stuff's crashing. I don't do international real estate. I do read about what's going on in other markets in case there's anything there that I can draw from it that can help us in understanding our market or potentially warn us about things that might be coming our way as a result of international influences on real estate. So if you're someone who keeps track of that, you know that China is just absolutely into the dump. I mean, it's the ultimate real estate bubble for China right now. And their problems are compounded for a lot of other reasons, but they're not consuming this year. So, I mean, and the numbers from last year don't reflect a big China influence. So all we're really seeing now in terms of our domestic lumber consumption right now, or the demand for it, is really being defined by our needs or what we're up to in real estate. So what's interesting is, while we are still continuing to see an awful lot of multifamily starts, the fact that we've seen an increase in the demand in terms of lumber prices, that's a good thing. So that means that we're starting to see more folks that are buying the materials they're going to need to start those construction projects. And with any luck, that's going to mean that we're going to see more single-family construction in a lot of these different marketplaces. So just hold on for that. That is a real-world indicator, right? So we've talked about before how there's often a disconnect between home builders and their actions. This was maybe a month ago, 2 months ago, where permits were down, architects weren't seeing as much action, all of those things that would indicate to someone that construction is happening or that builders are looking into building. None of these builders were doing it. They were talking about how confident they were, but they weren't carrying those actions out. So this is an indicator. This is a real world, honest to gosh, someone is consuming a product that makes homes, and it's a solid indicator that we're going to see some stuff kicking off here in the near term. So in general, that's good news. I think that's a good thing, and I think that means we can look forward to some more construction early next year. The downside, though, is it's still not at a level that comes anywhere near what we need to fill a lot of the demand. So we need to kind of take that into account as well. While these numbers are good, and particularly when we compare them to last year, we all know that for quite a few years now, the level of construction has been ridiculously low given what the market demands are right now. So take some comfort in this, but it's sort of a drop in the bucket in terms of meeting demand or setting a stage for us to think that there's a huge push. I'm going to go ahead and post to Pinterest this particular chart. But even if you just look at it going back to 2004, we're not seeing lumber prices even at the 2004, 2005 levels. And if we could go back further than that, we would see lumber prices going higher as we had big pushes in times when homes were really seeing a surge in building. So don't jump on board in terms of thinking that finally the pressure is going to come off at the levels we're seeing here. I honestly wouldn't call this a great source of relief, but at least it's better than it going than having it going the other direction. Now, another little tidbit that came across my desk that I wanted to cover was homeowners' estimations of the value of their home versus appraisals. Now, over the last year, we've seen this swing. About a year ago, owners were actually underestimating the value of their home by a couple of percentage points, which was interesting, right? Well, then we saw that sort of change gradually, and it got to be to the point where the sellers were dramatically overestimating the value. I think in some areas we were seeing overestimations creeping up to 7-8%. And I think that fed a lot of these prices that we've seen in terms of markets just demanding ridiculously high prices. What's interesting now, though, is that this has narrowed quite a bit. So the trend is actually towards sellers softening on their expectations in terms of how much their home is going to sell for. Now, this is an article that comes to us from Risk Media, and appraisals lagged behind what homeowners estimated by about 1.26% in September. Now, that's according to Quicken Loan's National Home Price Perception Index, and this is an index we've used before, so this is consistent with past, or excuse me, by the same source as data we've looked at before. And this is, according to them, a slight move toward equilibrium after a 1.56% gap between perceptions in August. And it was much higher than that earlier in the year and this time last year. So it's good to kind of see these two things coming together. Now, nationally, home values made a slight dip in September as measured by Quicken Loan's Home Value Index. Average appraisals fell 0.28% from August, but increased to a robust 7.78% since September of 2015, so with a year-to-year change. So what does this tell us? This is an interesting number, but what does it tell us? I think that it gives us a little bit of insight into what sellers' expectations are. They're far more realistic in terms of being compared to past months and about the same time last year. And this softening, I think, indicates that they may be more open to a more aggressive stance from buyers. Now, obviously, we'd much rather have a situation where buyers or sellers are underestimating simply because that's where their mindset is, right? And oftentimes, what you're fighting as a buyer or an investor is a seller perception that may or may not be represented by reality. Now, let me give you a real-world example. This is a property that I'm interested in making an offer on, and it came across my radar probably 5 months ago, and they listed it for $699,000. And at the time when I looked at it and I did a quick comparison, it was ridiculously overpriced. By at least $50,000 by my estimation. Now that property, and you know what? Initially it listed at $665,000, which was far more reasonable. Then it got boosted to $699,000 because the seller got advice from another agent who told them it was worth so much more. Never did sell. It's still on the market. And now the listing has been adjusted to $675,000. The reality is that between the time, if they had listed it at $665,000, and I've actually talked to the listing agent, and he fought to not let this get raised that high, but he says it would have sold if it had stayed at $665,000. I think that's a fairly reasonable expectation. It's in a good part of town. And in terms of the town that we're talking about, it's the most desirable area of that town. So very well could have. I would actually call it a margin call because I actually think the right price is closer to $650,000. But the reality is that's what he was dealing with. The problem was a perception on the part of the sellers. And who knows where these perceptions come from? These sellers talked to this agent that they signed a listing agreement with. This is what blows me away. So the sellers picked a listing agent. They get a friend of the family or a friend of a friend or somebody who's also a licensed agent who gives them the opinion that the home is actually worth $699. Now, after the fact, they weren't able to produce whatever market analysis this person supposedly did for them or whatever to validate this price. But it's a price that's clearly out of whack. And I, in the back of my head, I'm guessing exactly how it was out of whack by taking numbers from a nearby community that tends to be a much more luxury community. But anyway, that's neither here nor there. Simply because I think this other agent, we're getting into the weeds, I apologize. I think that in this particular situation, this scenario may have been that other agent may have been hoping that by saying they could sell it for a higher price, that this person might fire their current listing agent and then hire them. So unfortunately, that will happen sometimes. But the point is, and I think I'm speaking directly to sellers here, when you come into this and you want to set your own personal expectations on what your property is going to sell for, make people prove it. Because the bottom line is a huge chunk of agents out there are going to tell you what you want to hear. They are going to say, I will be able to sell your home for this crazy amount of money. They know that they're saying they can list it and sell it for higher than probably what most other agents are going to tell you. And they have no intention of actually being able to sell it for that amount of money. They simply want you to sign the paperwork. And that way, it's much easier to simply keep you as a listing. Because if they're one of these folks that really sticks to the listing agreement, you will still owe them a commission, even if you sell it X period of time after you cancel the agreement. So you get locked in for this kind of thing. So you need to really understand that your expectations on price, excuse me, are based on good numbers. Don't let them, and make them show you on a map where all these comparable homes are. Make sure the square footage is similar. Bedrooms and baths numbers are similar. Same school district, particularly in the case of this home, which is a huge deal in this particular area. Make sure those numbers are valid, because these folks, these sellers, because of their perception, really threw off their potential sale. Now, that's from the seller side. From the buyer side, you can find that a seller who's been convinced of this so desperately wants to believe it that even if you come in with an offer that's absolutely reasonable, that may even be a couple of $1,000s higher than what the competitive market says it should be, they may turn down your offer because they've had this happen, because they've had this thing set in their brain of how much that they think it's going to be worth. So it's a very much of an uphill battle for you. Now, how do you combat this? How do you combat a seller that has an inflated estimation? Well, the good news is you have less inertia now to deal with than in the past, because homeowners are much closer in their estimation of what a home is going to be worth in comparison to what the appraisal ends up coming in at. So that's good news. But in order for you to fight it as a buyer, when you make an offer that is below asking price, you need to provide the exact same kind of data that your agent, as a buyer's agent, provided you, or they should have provided you, when you decided what the price should be. So if you are doing a market analysis and after all of the massaging of the data, you come down with a number that is $15,000 below their current asking price, you should include that with your cover letter. Yes, you should make sure you have a cover letter included with your offer. Your agent would normally be the one to write it for you. I think it diffuses a lot of potential personal stuff by having your agent write the cover letter. I write one for every offer that I submit, and I explain every decision that was made, the checkbox stuff, how long I'm having the appraisal contingency on. All of those things get explained in that letter, so that there's not a single thing anybody can look at and go and assume some really nefarious reason why I chose to do something a certain way. And the number one thing that you are going to piss people off over is going to be that list price, or that offer price, particularly if it's not for list price, and particularly if it's substantially below list price. And I tend to be an aggressive offer guy. I will go, because there's no harm in asking other than the potentially alienating the other party. But if you believe that you're in a situation like that where you might alienate someone, just say, hey, this is simply me looking at the numbers. Here's the numbers I see. If I've missed a comparable property that you think really supports the sales price you're talking about, I'm more than happy to look at it. But given what I'm seeing in the marketplace and given where things are right now, and you can even say where things are going, I've even included articles that show the trend, right, that talk about the trend. And this is something that oftentimes when you're right at the beginning of a decline can really work to your advantage. If you can say, here are projections of what people expect in the marketplace we're in right now, and see things can just going down or staying flat for a really long time, use those. Include them with that cover letter, and don't say things like your house. Well, you won't be saying it. Your agent will be writing it. Your house just isn't worth it. It's this other house that sold for less, has much better stuff. You need to keep the emotional side of it out and simply phrase it as being just a reasonable person trying to look at how the market is. This looks like the right price. Here's the information we used to come to that conclusion. Let us know if you've got more information that we weren't aware of, because we'd be happy to do that or to consider that. So just keep that in mind. I think, again, the data's moving in your direction. So the bigger point I'm trying to make, aside from just the specifics of what steps you can take to remedy these kinds of problems in terms of trying to get those prices down, the idea that sellers are coming back into a place where their expectations aren't as out there as they were, I think is going to work to your advantage. And I actually think, and this percentage thing tends to be something that gets closer and closer to reality as you move further into the year and get longer days on market numbers. As sellers have to hold on to a property longer, they start coming to the conclusion, well, all these other homes sold, ours is still on the market. It's the only thing that's a variable here is the price. And then they start to realize it. And that's when you can come in, and when that reticence to stick on a certain price starts to weaken, and that's your opportunity to potentially get yourself a better deal on a property that you've been probably shopping for a very long time. All right, folks, we are going to take a quick break, so don't go away. We'll be right back with the story of the day, which is probably, should we buckle our seatbelt for a recession? So don't go anywhere. I'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We've been sort of doing the rounds on just a few interesting tidbits of information. We talked a little bit about lumber prices and what that informs us of, or what expectations it might set in terms of what we might see coming down the pike for the real estate market. Then we talked a little bit about an interesting change over time of homeowners' expectations on their home values. It is moving in the right direction, or at least in the right direction if you're a buyer, in terms of them potentially being a little bit more open to the possibility of paying a lower price for their home. But it's always a tough one to navigate, particularly when you're trying to absolutely keep a good relationship with a seller. But just something that helps you understand that it might be a little bit softer ground for you moving forward. All right, so now it is time to securely fasten our tin foil chapeau. We've got an article from the good folks at Zero Hedge titled, "It's About Time for a Recession," according to a property manager who warns of rents dropping for the first time in their career. This is a very interesting one. It ties together a lot of cool stuff that we've talked about, but particularly there's a quote from the Wall Street Journal. So this is just data, right? This isn't, again, Zero Hedge going crazy. This is an analysis of rents from the Wall Street Journal that I think is absolutely worth reviewing and definitely indicates things are probably moving in the direction that we've talked about here on this show. Now, one other very interesting point here is these folks then tie this in with employment numbers and sort of give us some insights into what might be further feeding this. And I think it makes a good point. So we're going to go ahead and review this. There are several charts associated with this article, which I'm absolutely going to be putting up on Pinterest. So make sure to check those out. And if you'd like to check out the show notes for today's show and see links to these articles, head on over to therebelbroker.com and then click on read more when you see today's show. It should, if you go today, it'll be just, and for all weekend, it will be just the first show listed there on the list of shows that's below the player. So just jump right in there, click on read more, and you'll be able to see what we're talking about. Now, let's see here. Earlier this week, they pointed out that the volume of apartment sales in New York was down 20% year over year. We talked about this here in the third quarter of 2016 as buyers disappeared while sellers who have grown accustomed to selling above asking price were slow to concede pricing concessions. Now, the Wall Street Journal seems to be catching on to the carnage, noting that residential rental rates have collapsed in San Francisco, San Jose, and New York. So these are kind of interesting numbers. And I'll be honest with you, I have not seen this as much. Now, granted, they're talking about this being something happening just in this quarter. So we'll have to see. But I know an awful lot of folks who rent properties. I'm pretty familiar with what things are renting for in my area. I haven't seen a decline. So this may either be more cutting edge than even me sitting here with a front row seat is seeing. But it's the numbers are good. So we'll just go ahead and sort of run through them. Now, here is a quote from the original New York Times article. Quote, San Francisco and New York are leading the way in the downturn. That's according to Ken Rosen, chairman of the Fisher Center of Real Estate and Urban Economics at the University of California at Berkeley. Quote, people are going to be surprised that this is happening, but they shouldn't be. It's been too far, too fast. The rental market is coming off its biggest boom in decades. The foreclosure crisis, along with a trend toward urban living, has created 7 million new renter households since the housing market peaked in 2006 as the home ownership rate declined to 51-year lows. Now, if we take a look at this, U.S. home prices has stayed relatively flat in this particular graph, at least on a quarter-to-quarter basis. It was up in 2013, took a bit of a dip in terms of percentage increases, right? So in the second quarter, it was a 1.2% increase, and that seems pretty steady going all the way back to 2014. And then prior to that, there's a little bit of a hump there. And then, of course, there's declines in some prices in 2011 and 2010. But that's not the sexy part. The percentage change in home prices is not really the sexy part. The quarterly change in residential rents is what's kind of amazing. Now, in the U.S. in general, they've seen a 4.1% increase. So let's keep that in our back pocket. That's a positive number. In San Jose, they're down 0.5%. In New York, they're down 1.1%. And in San Francisco, leading the way with reductions in rent, they're down 3.1%. Now, let's step back for a minute just to yesterday's show or the show relating to, we were talking about ranked rental places, different regions, different metro areas, and the sub-metro areas. It's a tool. Remember the tool from Zillow that I was sharing with everybody? What did that tell us? It told us the expected growth in a lot of these different areas. And the areas that weren't these big, sexy names, remember, and I specifically called that out. These big, sexy names are not where you want to be in terms of getting the biggest bang for the buck right now in what you're trying to do. And we ended up pointing our gaze to a city like freaking Hollister, for instance, where rentals are expected to really shoot up in that area, whereas those expectations were not as high, according to Zillow. But Zillow also did not expect a decline, while these folks from the Wall Street Journal are not only saying it's happening, but judging by the trend lines here, it's likely going to continue. The main cause of the rent slowdown is a flood of new supply, according to the New York Times, with more than and while that's very true on apartment rentals, that's not even true everywhere. South San Jose has seen a huge increase in some regions in terms of apartment complexes. I've talked about the sort of 9-building development that's in South San Jose right off the 85 freeway that's something like 9 or 10 stories tall, just packing them in like sardines. And I offered some theories on what will ultimately happen to that stuff. The main cause of this rent slowdown is a flood of new supply, with more than 55,000 units under construction across the 100 largest U.S. metro areas. Tenants also are beginning to tighten their purse strings as rents have jumped by as much as 60% in some markets since 2010. Which is why we've seen growth in these mushroom cloud areas that I keep talking about, where you find out where rents are the most expensive, you move a city or two over, or a 30-minute commute over, 20-minute commute over, and you're going to find yourself with communities where you can get in there and get in on some rental properties where you're going to see growth in your rental rates. All right. Growth of high-paying jobs, meanwhile, and here's the key part, growth of high-paying jobs, meanwhile, is slowing in New York, San Francisco, and nearby Silicon Valley. Almost 6,700 additional apartments are expected to be built in San Jose, and nearly 6,500 more in San Francisco by the end of 2018, according to Axiometrics. New York is expected to get more than 42,000 new units during that same period. So it'll be interesting to see if this all actually plays out. Remember, we also talked about how the city of Mountain View had said that they did authorize the construction of 30,000 more residential units just within their city, and Mountain View is not a giant city. So that's, not 30,000, 30%. I think it was it 30% or 30,000? I'm sorry, my brain is not working. It was a 30% increase in their overall residential units. So that for a city of that size, I think that's actually a pretty dramatic jump. Now, if you there's another chart here, year-over-year growth in terms of multi-unit housing. That's where we've seen it. Multi-unit housing was down dramatically in 2009, 2010, 2011. And then where we've really seen this growth has been since 2012. Now, it really sort of peaked around 2013, but it's been declining. What I find most interesting is the difference in housing units between 2015 and 2016. Now, this chart I have a hard time believing because there's been so much out there relating to this stuff being blocked. But what's interesting is if you look at this next number is San Francisco, Oakland, and San Jose. So it's a combination of all these areas. And I do know that the East Bay, including Oakland, and I'm sure they're probably including Fremont in this, have seen an awful lot of growth in terms of rentals. And then when you figure in South San Jose, that all figures in. It hasn't been nearly as much in actual San Francisco as this seems to imply. But still, within that mushroom, within that umbrella of area that folks would be willing to live and then commute to San Francisco, what we have seen between 2015 and 2016 is a 76% increase in housing units. San Francisco, Oakland, San Jose are facing among the largest supply gluts in the country, with a 76% surge in new housing units coming online in 2016. So when we talked about really low construction, that was a national number. We weren't seeing what was happening locally here. It sounds like a lot of these have been focused in these metro areas and have just blown the doors off. So if we've gone from 7,000 in 2015 to 12,300 in 2016. Now, remember, this is all going to be profoundly dominated by multifamily style stuff. So keep that in mind. The next important number for us to look at is the employment situation. If we take a look at right around May of 2015 till now, unemployment has actually, or the increase in employment has actually flattened pretty dramatically, to the point where we're absolutely creating sort of a similar scenario to what we lived through before. And I find it interesting that these two things are coming together, because if they do, what we'll see is a dramatic increase in the number of units in 2016 for rent. But what we'll see over the coming months, if this chart holds out, is a decrease in the number of folks or not much growth in the number of folks who want to come here and rent because the employment situation has softened. So here we go. Here's another quote from the Wall Street Journal. Listings that once rented in just 2 to 3 weeks can now take 2 to 3 months to rent. And that's from San Francisco, principal broker at Skybox Realty, a San Francisco-based real estate agency. At least 4 new apartment buildings have opened within a 3-block radius of one another during the last 18 months in San Francisco's thriving South of Market neighborhood, which is home to major tech companies like Airbnb, Pinterest, and Yelp. Those 4 buildings, Jasper, 340 Fremont, 399 Fremont, and Solaire, frequently offer some sort of bargain for prospective renters. 340 Fremont is offering 6 weeks of free rent. Solaire is pitching 4 weeks of free rent, free on-site storage, and $1,000 discounts to renters who work at tech companies like Apple, Facebook, Yahoo. Meanwhile, another building, 399 Fremont, even tried giving away free bikes one weekend. When you see that kind of stuff, that tells you that these renters, these landlords, are very concerned about getting their places full. The increase in supply in New York is forcing down rental rates on existing capacity as well. Another quote from the Wall Street Journal, Eugene Korzunski, president of Intempest Realty, a San Jose real estate brokerage firm that manages apartments and single-family homes for landlords, said that the past couple of years, apartments sat on the market for about a week. Now it can take them nearly a month to find a tenant. Quote, we've actually had to drop the rent on some properties, which I don't think I've ever done in my career, he said. Tenants are even gaining the upper hand on renewals. Landlords typically drive a harder bargain on such leases because they know residents would rather avoid the hassle of moving. So here we are. I mean, this is starting more and more to feel like a pivot point. We were talking about this just yesterday. Once you get to a point where you start to experience certain sorts of shifts in the marketplaces that aren't just isolated, and these are the exact words I was using, I think, yesterday. Once you start to see it more broadly applying in different major areas across the country, that's when you need to start thinking about fastening your seatbelt. So moving forward, depending on where you are, the idea that I've always pushed that you want to be mentally prepared as a landlord for a potential flattening or dropping of the rents that you're going to be able to charge to a good tenant, you need to be calculating that in and being prepared for that. I think this potentially could absolutely be another one of those dominoes that we're getting pushed over that indicates to someone looking at this that we are starting to be at a pivot point where things are about to change, where we start to see a shift. Now, what's interesting is I think that so much of this and all this construction, all these residential units, it's all rentals, right? We still have what's amazing is we still have this problem of folks who want to purchase. So, and people will complain and say, "Oh, God, we've done all this stuff with residential in terms of apartments." Well, today's apartments are tomorrow's condos. If these folks end up having to reduce the rent to the point where it doesn't make sense for them, you're suddenly going to find these places no longer will be apartment buildings; they will be condominium buildings. And this was something I talked about several months ago in terms of something to look out for. Where once this does happen, once we start to see a softening, you'll absolutely end up with some of these buildings going condo. And some of them will make horrible condos, like the ones in South San Jose that I was talking about, ridiculously crammed together. That's just a recipe, I think, for bad stuff in terms of just decline in value. And this development is gigantic, so it'll be interesting to see how that one ends up coming through. The big thing, what's the big fuel for this particular fire? I think unemployment numbers. I think if we start to continue to see tech companies not growing, if we continue to see tech companies seeing their stocks get hit, and what's the number one thing that's likely to hit the stock market? An increase in interest rates from the Fed. And that's a must-have. That's something we got to do. It's going to be ridiculously painful, and it's going to absolutely hit the value of stocks, which is going to be reflected in high tech, which is absolutely going to cause these folks to tighten their belts a little bit, and not only maybe freeze hiring, but maybe even start to trim off some of the folks that they can manage to move forward without. So keep an eye on that. If we continue to see that snowball get bigger, these numbers are going to continue to drop in terms of what folks are getting for in terms of rents. So stay tuned. This could be a very interesting ride. All right, folks, I appreciate you making the show a part of your daily routine. I absolutely understand the value of your time, and all I can hope for is that I am giving you some value in return in terms of the topics we talk about, at the very least, entertaining you for a little while. Thanks again for listening. I hope you all have a fantastic weekend. I'll talk to you all next time.